Recently, Buffett has issued a warning signal. An impending market crash could be on the horizon. So, are you prepared for the inevitable market crash? Don't ignore Warren Buffett's warning, because his market crash warnings are rooted in decades of financial wisdom. If you're not heeding his advice, your portfolio could face devastating losses in the next market crash. Your investments could plummet by 30%, 40%, or even more. Stick around as we unpack Buffett's insights and what they could mean for your financial future. Understanding these warnings could be crucial in safeguarding your investments during turbulent times. Warren Buffett's track record. Warren Buffett's historical predictions regarding market trends have made him a beacon of wisdom in the investment community. One of the most notable moments came in 2007, when he warned about the impending housing market collapse. His foresight allowed many investors to reassess their portfolios before the financial crisis hit in 2008, showcasing his ability to read the signs of economic distress. Similarly, during the dot-com bubble in the late 1990s, Buffett cautioned against overvalued tech stocks, a prediction that proved accurate as the market corrected itself in the early 2000s. Buffett's insights are highly valued by investors globally, not just for their accuracy but also for the principles behind them. His investment philosophy emphasizes long-term value over short-term gains, focusing on companies with strong fundamentals and sustainable competitive advantages. This approach has garnered him a loyal following as many investors seek to emulate his strategies in their portfolios. Moreover, Buffett's ability to remain calm during market turbulence has made him a trusted voice in uncertain times. His historical predictions serve as a reminder that understanding market cycles and economic indicators can be crucial for successful investing. As we explore Buffett's track record, we gain valuable lessons on the importance of patience, research, and a disciplined approach to investing. By learning from his insights, investors can better navigate the complexities of the market and make informed decisions that align with their financial goals. If you are enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. Current market indicators. As we analyze the current economic landscape, several indicators suggest that a potential market crash could be looming. Recent trends in stock prices have shown increased volatility, with major indices experiencing sharp fluctuations. This instability often signals investor uncertainty, which can be a precursor to more significant market corrections. Additionally, economic data reveals mixed signals. While some sectors show resilience, others are struggling to maintain momentum. Inflation remains a critical concern, with rates reaching levels not seen in decades. Rising prices for goods and services can erode consumer purchasing power, leading to decreased spending and ultimately slower economic growth. Coupled with this as the Federal Reserve's response to inflation, which has included raising interest rates, higher interest rates can dampen borrowing and spending, further impacting corporate profits and stock valuations. Unemployment rates, while relatively low, have shown signs of stagnation in certain industries, indicating that not all sectors are recovering equally. This uneven recovery can create vulnerabilities in the market as companies in struggling sectors may face significant challenges. Experts' opinions on the current market climate vary, but many analysts express caution. Some suggest that the combination of high inflation, rising interest rates, and economic uncertainty could lead to a downturn. Others argue that strong corporate earnings and consumer resilience may provide a buffer against a crash. As we navigate these complex indicators, it's essential for investors to stay informed and prepared for potential shifts in the market. Understanding these dynamics can help in making strategic investment decisions. Buffett's warning signs. Warren Buffett has recently highlighted several key warning signs that suggest potential trouble ahead for the market. Among these indicators, he has pointed to elevated stock valuation, particularly in technology and growth sectors, which he believes are unsustainable high. Buffett has also expressed concerns about rising interest rates, emphasizing how they can impact borrowing costs and consumer spending. Additionally, he has noted the increasing levels of corporate debt, which can pose risks during economic downturns. The significance of these warning signs for investors cannot be overstated. High stock valuations often indicate that the market may be overextended, leaving little room for growth and increasing the likelihood of a correction. Rising interest rates can lead to decreased consumer confidence and spending, which are critical drivers of economic growth. Furthermore, elevated corporate debt levels can create vulnerabilities for companies, especially if economic conditions worsen and cash flow becomes constrained. These warning signs are particularly relevant when we consider historical market crashes. Take the dot-com bubble as an example. Many companies had inflated valuations that ultimately led to a significant market correction. Similarly, the 2008 financial crisis was exacerbated by high levels of corporate debt and risky lending practices. By recognizing these patterns, investors can better prepare for potential downturns. Buffett's insights serve as a reminder to remain vigilant and to consider the broader economic context when making investment decisions. Understanding these warning signs can help investors protect their portfolios in uncertain times. Impacts on investors. Warren Buffett's warning about a potential market crash could have significant implications for both individual and institutional investors. In response to his insights, many investors may adopt more conservative strategies, such as reallocating their portfolios to include safer assets like bonds or defensive stocks. This shift could involve reducing exposure to high-risk sectors, particularly those that Buffett has flagged as overvalued, and increasing investments in companies with strong fundamentals and stable cash flows. The psychological impact of market crash predictions can be profound. Fear and uncertainty often lead to panic selling, where investors rush to liquidate their positions to avoid losses. This behavior can exacerbate market volatility, creating a self-fulfilling prophecy where fear drives prices down further. For individual investors, this can lead to emotional decision-making which may not align with their long-term financial goals. Historically, investor reactions to similar warnings have varied. During the 2008 financial crisis, many investors ignored early warnings about the housing market, only to face significant losses when the market collapsed. Conversely, some savvy investors who heeded warnings about inflated tech stocks in the late 1990s successfully repositioned their portfolios before the dot-com bubble burst, preserving their capital. Ultimately, Buffett's warning serves as a crucial reminder for investors to remain vigilant and informed. By adopting a proactive approach and considering the potential risks, investors can better navigate the complexities of the market and make decisions that align with their financial objectives regardless of external predictions. Preparing for a market crash. As we consider the possibility of a market downturn, it's essential for investors to take proactive steps to safeguard their financial well-being. One of the most effective strategies is diversification. By spreading investments across various asset classes such as stocks, bonds, and real estate, investors can mitigate risks associated with any single market segment. This approach helps cushion the impact of a downturn, as losses in one area may be offset by gains in another. Another critical aspect of preparation is having an emergency fund. Financial experts recommend setting aside 3 to 6 months' worth of living expenses in a readily accessible account. This safety net can provide peace of mind during turbulent times, allowing investors to avoid panic selling and make more rational decisions about their investments. An emergency fund can also cover unexpected expenses, reducing the need to liquidate investments at unfavorable prices. Staying informed and educated about market trends is equally important. Regularly following financial news, reading market analyses, and understanding economic indicators can empower investors to make informed decisions. Knowledge of historical market patterns can also provide context for current events, helping investors anticipate potential risks and opportunities. By implementing these practical strategies, diversifying investments, maintaining an emergency fund, and staying informed, viewers can better prepare for a potential market crash. If you want to know more about the path to prosperity, check out the video here and see you there.